AI hype has lifted the S&P 500 and NASDAQ to new heights. Critics warn it might not last. When does the AI boom become an AI bubble? Here to tell us is Morgan Stanley Private Wealth Managing Director Chris Toomey. Chris, great to see you again.
Thanks for having me.
Thanks for coming in.
Yep.
So all these warning signs we see, NVIDIA popping from $4 trillion to $5 trillion in, I think, 73 trading days, 78 trading days. It is now, its market value is larger than any nation on earth except for China and the U.S. You've got margin debt at all-time highs. You've got, 35% of the S&P 500 in 7 or 8 companies. To the client who says, Chris, I lived through the dot-com bust. I promised myself next time I'd sell before everything went down. I want to sell now. What do you say to that client?
You know, look, I think you have to understand kind of what your risk return situation is. And so for clients that are uncomfortable and for this not necessarily being the right type of strategy, you definitely want to start taking down some of that risk. However, I think you need to look at exactly what's driving this. So if you look at GDP this year, almost 90% of it is being driven by this kind of AI miracle. In addition to that, 80% of earnings are being driven by this same kind of trend. And
is that a bug or a feature?
I think that's part of this whole story playing out. And I think if you look at the bubble in the 90s, I think you saw technology companies trading at about 60 times earnings. Right now, they're about 30 times. So they're not cheap, but they're nowhere near where they were before. They're twice as profitable. I think one of the big comparisons you typically see is a company like Cisco versus NVIDIA. If you look at Cisco back in those days, it was trading at about 100 times, mid-teens growth. You look at a company like NVIDIA, trading at almost 30 times over a 2-year period and over 80% earnings growth. So I don't necessarily think we're there yet, but there's definitely a lot of momentum in this trade.
So one of the things that saved you in 2000 was if you had small caps, if you had value stocks. Those actually just went up nicely. I mean, they were so cheap in 1999, they went up nicely. Is there a part of the market now that looks undervalued like that, a good place to hide?
I would be careful just looking broadly within different asset classes. I think we're in a different type of market now where there's so much more passive money in versus active money. I think if we do start to see some cracks within the AI trade and equity markets selling off, I think it's probably going to be a pretty significant risk-off type of trade. So there might not necessarily be traditionally types of places to hide like small caps. One of the areas we do like that might be a little bit more defensive is healthcare. Trades at a very low multiple, about 17 times, and it hasn't really priced in some of the efficiencies that you're going to expect to see with regards to AI. So I think that's probably a good defensive place to be. But you could always look at reducing your equities and going to cash or short-term fixed income.
Sure. Morgan Stanley came out with a bull case that had the S&P hitting 7,200, and the bear was 4,900. And I thought, I think that's about 3% on the upside and about 29% on the downside, which, to your point, do I like that risk return?
Well, I think that's our expectation for mid-year next year. Okay. I think as we get closer and closer to the end of the year, we're about 50% through earnings for the third quarter. They all looked relatively good. We've got a situation where M&A is picking up. We got a 40% increase in M&A year over year. IPOs are coming, and we still haven't seen that stimulus yet from Washington, as well as the fact that while the Fed might be pausing, is still very accommodative. So liquidity is very good in the market. We expect, this continue to fall through within earnings. And so our base case is probably closer to our bull case. Our expectations are probably the bull case will start to move higher.
And on the stimulus point, David Kelly at JP Morgan has pointed out that people will be getting tax refunds in April. That'll be nice. One other area that is both an AI play and kind of defensive is energy, because obviously it's got to power those data centers, but we're still going to be driving cars even if things turn south. What's your view on that sector?
Yeah, I mean, if you look at performance this year, the typical kind of growthy areas, technology, consumer services, as well as industrials have done well. Utilities up over 20%, energy up only about 9%. So that's probably an area where in a situation where we need to grow our capacity for energy and infrastructure almost 2 times in the next 3 or 4 years, I think you're going to start to see some real opportunities, not only in energy, but in energy infrastructure. And so that's one of the areas that we're looking to add exposure to is around that whole infrastructure play to build out within data centers and compute. You need energy to get there. And so that's probably another good area to add exposure exposure to.
And the grid has been crying out for improvements for years, so definitely.
Absolutely.
Chris Toomey, thanks very much for coming by.
Thank you for having me.